Financial planning. What is GST? GST stands for Goods and Services Tax. To understand GST, we must first understand what is tax. Tax is a sum of money demanded by government for providing specific facilities and services like education, to maintain or build roads, military, etc. GST is also called as One Nation, One Tax. GST was first implemented from July 1st, 2017. Features of GST are as follows. Many indirect taxes in India like excise duty, custom duty, VAT, entertainment tax, central sales tax, services tax, octroi are subsumed under GST. State-wise registration for traders. GSTIN holder needs to keep all the records and should pay GST in time. Due to GST, there is a transparency in transactions. This tax system is simple and easy to understand. Before GST, if a customer would have bought a car, then after levying different taxes, cost of car for a customer would have been rupees 3,63,000. But after implementation of GST, the same car costed him rupees 3,60,000. There is a difference of 3,000 rupees. So GST has removed cascading effect of taxes and hence the prices are controlled. There is an increase in quality of goods and services as they are globally competitive. It has given a boost to Make in India project. Technology-driven tax system has led the speedy decisions. Goods and service tax system is a dual model as equal amount of tax is levied by central and state governments. Previous tax system was divided into two broad categories. One, direct tax, imposed on a person and paid directly to the government like real property tax, income tax, corporate tax, etc. 2. Indirect tax, paid indirectly via third person, is imposed on goods and services like restaurants, transport, etc. Indirect taxes are collected by central government and state government. Central government collects taxes like excise duty, service tax, CST custom duty. State government collects taxes like VAT, entertainment tax, luxury tax, octroi, etc. All major indirect taxes are subsumed under GST. Let us take a look at sample of tax invoice for goods purchased. Now we will see what the different components of such invoices are. A standard invoice bill consists of name and address of a shop, contact number and email ID of the owner, invoice number and date. Top right corner contains GSTIN, Goods and Services Taxpayer Identification Number. GSTIN is mandatory for the dealer whose annual turnover in previous financial year exceeds rupees 20 lakhs. All goods are classified by giving numerical code called HSN code, Harmonized System of Nomenclature. GSTN has two components, CGST and SGST. CGST is Central Goods and Service Tax, which is to be paid to the central government, whereas SGST is State Goods and Service Tax, which is to be paid to the state government. Now we will see a sample of a tax invoice of services provided. Services are classified by giving codes called as SAC, Service Accounting Code. Remember, in the tax invoice for goods, there is HSN code, while in service invoice, there is SAC. There are 5 types of rates of GST. 1. Zero rated. In this category, rate of GST is 0%. It is applicable on essential goods like food grains, fruits, vegetables, milk, soil, earthen pots, etc. And services like charitable trust activities, transport of water, use of roads and bridges, public library, agriculture-related services, education and healthcare services, etc. 2. Low rated. In this category, GST rate is 5%. It is applicable on commonly used goods like commonly used items, LPG cylinder, tea, coffee, oil, honey, frozen vegetables, spices, sweets, etc., and on services like railway transport services, bus transport services, taxi services, air transport, economy class, hotels providing food and beverages, etc. 3. Standard rated, 1 slab, GST rate is 12%. It is applicable on goods like butter, ghee, dry fruits, jam, jelly, sauces, pickles, mobile phone, etc. And on services like printing job work, guest house, services related to construction business. 4. Standard rated, 2 slab, GST rate is 18%. In this slab, most of the goods like marble, granite, perfumes, metal items, computer printer, monitor, CCTV, etc., and services like courier services, outdoor catering, circus, drama, cinema, exhibitions, currency exchange, broker services in share trading, etc. 5. Highly rated GST rate is 28%. It is applicable on goods like luxury items, motorcycles and spare parts, luxury cars, pan masala, vacuum cleaner, dishwasher, AC, washing machine, fridge, tobacco products, aerated water, etc., and on services like 5-star hotel accommodation, amusement parks, water parks, theme parks, casino, race course, IPL games, air transport, business class, etc. Note: the rates and types of GST are as prescribed by the government at the time of writing this chapter. GST rates are subject to change. Electricity, petrol, diesel, etc. are not under purview of GST. Now, let us make a list of 5 goods and services we need in our daily life. Find the GST rates with the help of given GST rate chart. 1. Butter, rate of GST is 12%. 2. Milk, rate of GST is 0%. 3. Aerated water, rate of GST is 28%. 4. Coffee, rate of GST is 5%. 5. Cinema, rate of GST is 18%. Points to remember. Value of goods on which GST is levied is called taxable value. If total value is not mentioned, take SP as taxable. In tax invoice, rate of GST is equal to rate of SGST plus rate of CGST, where CGST is equal to SGST. Examples: 1. The price of a porcelain dinner set bought by Priyanka was rupees 5,500. Then what is the taxable value? Solution: here selling price is equal to rupees 5,500. Therefore taxable value is rupees 5,500. Since discount is not given, SP is equal to taxable value. 2. The discount of 10% was given to Priyanka on purchase of a porcelain dinner set on which the printed price was rupees 5,500. Rate of GST charged was 18%. Find the purchase price of dinner set. Also find the amount of CGST and SGST. Given. Printed price of dinner set is equal to rupees 5,500. Discount in percent is equal to 10%. Rate of GST is equal to 18%. To find purchase price of dinner set, amount of CGST and amount of SGST. Solution. Printed price of dinner set is equal to rupees 5,500. Discount is equal to 10%. Therefore, net discount is equal to 10% of 5,500, which is 10 upon 100 into 5,500 is equal to 550. Therefore, taxable value is equal to printed price minus discount is equal to 5,500 minus 550, that is 4,950. Amount of GST is equal to 18% of taxable value, which is 18 upon 100 into 4,950 is equal to 891. Therefore, purchase price is equal to taxable value plus amount of GST, which is equal to 4,950 plus 891 is equal to rupees 5,841. Therefore, purchase price of dinner set is equal to rupees 5,841. Since rate of CGST and SGST is same, 18% of GST is divided into two equal parts, that is 18 upon 2 is equal to 9%. Therefore, rate of CGST is equal to rate of SGST is equal to 9%. Therefore, amount of CGST is equal to amount of SGST, that is equal to 9% of taxable value, which is 9 upon 100 into 4,950 is equal to rupees 445.5. Therefore, amount of CGST and amount of SGST is equal to rupees 445.5. Try some more problems for practice. Remember, trading between GSTIN holders is known as business to business, in short B2B. Trading between GSTIN holder and consumer is known as business to consumer, in short B2C. This is the last link in the trading chain. Input tax credit. GST is levied and collected at every stage of trading from manufacturer to consumer. Suppose a pen manufacturer buys raw materials like brass, tungsten, carbide, ink, etc. Let us assume that he has to pay a total tax of rupees 150 on these inputs. When trader pays GST at the time of purchase, it is called input tax. Then on sale of pens, if he has collected the GST is rupees 200, which is his output tax. The collected GST at the time of sale is called output tax. At the time of paying GST to the government, a trader deducts the input tax from the output tax and pays the remaining tax. This deduction of input tax is called input tax credit. Then manufacturer, while paying the tax to the government, has to pay the balance amount of rupees 50, which is equal to 200 minus 150. Thus, GST payable is equal to output tax minus input tax. Examples: 1. A retailer paid GST of rupees 7,000 at the time of purchase and he collected GST of rupees 9,500 at the time of sale. Find his input tax, output tax and ITC. Find is payable GST. Find the payable CGST and SGST. Solution. Retailers payable GST means GST to be paid to the government by the retailer. Output tax, tax collected at the time of sale is equal to rupees 9,500. Input tax, tax paid at the time of purchase is equal to rupees 7,000. Therefore, ITC is equal to rupees 7,000. GST payable is equal to output tax minus ITC is equal to 9,500 minus 7,000 is equal to rupees 2,500. Therefore, payable GST is equal to rupees 2,500. CGST is equal to SGST, that is equal to 2,500 upon 2, which is equal to rupees 1,250. Try some more problems for practice. There are many ways to invest money. Some of them are fixed deposit, recurring deposit, insurance, shares, provident fund, mutual funds, immovable property, jewelry, debentures, bonds, etc. Shares. People come together and form a company. A company has to be registered under the Indian Companies Act 1956. People who form a company are called promoters and the company is called limited company. In order to start the company, the promoters need money. Such an amount required to start a company is called capital. This capital is divided into equal small parts. This small part of the capital is called a share. A person who owns the share is known as the shareholder. Company issues share certificates to all shareholders. The value of a share along with other details is printed on it. Shares represent ownership of the shareholder. It means that the shareholder is a part owner of the company. The place where buying and selling of shares takes place is called the stock exchange. It is also known as share market or stock market. Companies should be listed in the stock market for the purpose of buying and selling of shares. The value printed on the share certificate is called the face value of the share. It is written as FV. It is also called nominal value or printed value or par value. The price at which the shares are purchased or sold in the stock market is called market value of the share. It is written as MV. Market value changes very frequently in the stock market. Let us see how our Apple company is performing better than expected, so it means that everyone will want to buy its shares. But number of shares are fixed in the market, so supply of shares cannot increase. But people want to buy more shares. Since the company is performing well, they are also ready to pay more to get the shares, and this is how the market value of such shares increases. If the company wasn't performing well, the share price would decrease. A part of company's annual profit is distributed per share among shareholders. It is called as dividend. For the shareholders, the dividend income is tax-free. Additional information. There are two main stock markets of India, BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. BSE is the oldest in Asia, while NSE is the India's largest stock exchange. The total amount required to purchase the shares is called sum invested. Therefore, sum invested is equal to number of shares into market value. When we invest in shares, it is important to know the return on investment, ROR. Formula for ROR is equal to dividend upon sum invested into 100. Brokerage and taxes on share trading. The registered members of stock market who can buy and sell on shares on behalf of people are called shareholders. For providing the service of buying and selling of shares, they charge some amount which is called Brokerage. Brokerage is always calculated on market value of shares. GST on brokerage services. Share brokers provide services for purchase and sale of shares for their clients. These services are charged under GST. Rate of GST is 18% on brokerage. Mutual fund. Many investors with common objectives give their money to the professional experts. Mutual fund is professionally managed investment scheme usually run by an AMC, that is Asset Management Company. They invest the money given by the investors in different schemes like equity fund, debt fund or balanced funds as per the investor's choice. Just like we get shares for the investment in share market, we get units when we invest in mutual fund. The market value of unit is called NAV, net asset value. NAV of one unit into number of units is equal to total fund value. Remember, as the market value of share changes frequently, NAV of a unit also changes. Comparison of face value and market value. If market value is greater than face value, then the share is at premium. If market value is equal to face value, then the share is at par. If market value is less than face value, then the share is at discount. If face value is equal to rupees 55 and market value is equal to rupees 55, then MV is equal to FV, therefore the share is at par. If face value is equal to rupees 60 and market value is equal to rupees 100, here MV is greater than FV, then share is at premium of rupees 40 since 100 minus 60 is equal to 40. If face value is equal to rupees 75 and market value is equal to rupees 50, here FV is greater than MV, then share is at discount of rupees 25 since 75 minus 50 is equal to 25. Example based on sum invested. If 20 shares of face value rupees 150 each are purchased for market value of rupees 165, find the sum invested. Solution. Here number of shares is equal to 20 and market value is equal to rupees 165. Therefore, sum invested is equal to number of shares into market value, that is equal to 20 into 165 is equal to 3,300. Try some more problems for practice. Example based on rate of return. 1. If 50 shares of face value rupees 200 were purchased for market value of rupees 400. Company declared 10% dividend on the shares, then find 1. Sum invested, 2. Dividend received, 3. Rate of return. Given number of shares is equal to 50, face value is equal to rupees 200, market value is equal to rupees 400, rate of dividend is equal to 10%. To find 1. Sum invested, 2. Dividend received, 3. Rate of return. Solution. Sum invested is equal to number of shares into market value is equal to 50 into 400 is equal to 20,000. Dividend per share is equal to face value into rate of dividend is equal to 200 into 10% is equal to 200 into 10 upon 100 is equal to rupees 20. Therefore, total dividend received is equal to number of shares into dividend per share is equal to 50 into 20 is equal to 1000. Rate of return on investment is equal to dividend income upon sum invested into 100 is equal to 1000 upon 20,000 into 100 is equal to 5%. Therefore, rate of return on investment is 5%. Now let us see another example where if number of shares purchased is not given, then we find ROR by following method. 2. Natasha purchased a share of face value Rs 170 for market value of Rs 250. Company declared 10% dividend on the share. Find the rate of return. Given face value is equal to Rs 170, market value is equal to Rs 250, dividend is equal to 10% per share. To find rate of return. Solution. Here, on investment of Rs 250, Natasha got Rs 10. Let the return be X for investment of 100. Therefore, rate of return upon dividend is equal to X upon 100. Therefore, 10 upon 250 is equal to X upon 100. That is, X is equal to 10 into 100 upon 250. We get X is equal to 4. Therefore, rate of return for Natasha is 4%. 3. If the face value of both the shares is same, then which investment out of the following is more profitable? Company A, dividend is equal to 16%, MV is equal to Rs 80. Company B, dividend is equal to 20%, MV is equal to Rs 120. To find profitable investment. Solution. Here, face value for both the shares is same. Let the face value be Rs 100. 1. For company A, FV is equal to Rs 100. Assumed, MV is equal to Rs 80. Dividend rate is equal to 16%. Therefore, dividend per share is equal to FV into rate, which is equal to 100 into 16%, is equal to 100 into 16 upon 100, that is equal to Rs 16. Rate of return is equal to dividend upon MV into 100 is equal to 16 upon 80 into 100 is equal to 20%. Therefore, the rate of return for investment in company A is equal to 20%. 2. For company B, FV is equal to Rs 100, assumed, MV is equal to Rs 120. Dividend rate is equal to 20%. Therefore, dividend per share is equal to FV into rate, which is equal to 100 into 20% is equal to 20 upon 100 into 100, that is equal to Rs 20. Rate of return is equal to dividend upon MV into 100. MV is equal to 20 upon 120 into 100 is equal to Rs 16.67%. Therefore, the rate of return for investment in company B is equal to 16.67%. Therefore, it is obvious that company A is more profitable. Try some more problems for practice. Examples based on brokerage and taxes. 1. Suppose if the face value of the share is Rs 200 and market value is Rs 350, let the rate of brokerage be 0.2%. What amount should one pay for purchasing 10 such shares? What amount should one receive after selling 10 such shares? Solution. FV is equal to Rs 200, MV is equal to Rs 350. Rate of brokerage is equal to 0.2%. To find total amount required to purchase 10 shares, amount received after selling 10 shares. Brokerage per share is equal to 0.2%. Market value is equal to 0.2 upon 100 into 350, that is equal to Rs 0.7. Therefore, purchase value of one share is equal to market value plus brokerage per share is equal to 350 plus 0.7 is equal to 350.7. Hence, the cost of purchasing 10 such shares is equal to 350.7 into 10 is equal to Rs 3,507. Here, Rs 3,500 is the share price and Rs 7 is the brokerage paid. Now, selling price of one share is equal to market value minus brokerage per share. That is equal to 350 minus 0.7 is equal to 349.3. Therefore, after selling 10 such shares, the person will get 349.3 into 10 is equal to rupees 3,493. Therefore, after selling 10 such shares, the person will get rupees 3,493. Examples based on GST on brokerage services. 1. Mr. Kumar purchased 1000 shares of market value rupees 50. Brokerage was paid at the rate of 0.5% and rate of GST on brokerage is 18%. Find the total amount he paid for the share purchase. Given number of shares purchased is equal to 1000. MV is equal to rupees 50. Rate of brokerage is equal to 0.5%. Rate of GST is equal to 18%. To find the total amount to be paid for purchase of shares. Brokerage per share is equal to 0.5 into MV. That is equal to 0.5 upon 100 into 50 is equal to 0.25. Brokerage on 1000 shares is equal to brokerage per share into number of shares purchased is equal to 0.25 into 1000 is equal to rupees 250. The cost of one share is equal to market value plus brokerage per share is equal to 50 plus 0.25 is equal to 50.25. Therefore, cost of 1000 shares is equal to 50.25 into 1000 is equal to rupees 50,250. GST on brokerage is 18% of 250 is equal to 18 upon 100 into 250 is equal to 45. Total amount paid is equal to cost of 1000 shares plus GST on brokerage is equal to 50,250 plus 45 is equal to rupees 50,295. Therefore, total amount he paid for the share purchase is rupees 50,295. Examples based on profit and loss. Market value of shares and dividend declared by the two companies is given below. Face value is same and it is rupees 100 for both the shares. Investment in which company is more profitable? For company A, MV is equal to rupees 132, FV is equal to rupees 100, dividend rate is equal to 12%. Dividend per share is equal to FV into dividend rate is equal to 100 into 12% is equal to 100 into 12 upon 100 is equal to rupees 12. Rate of return is equal to dividend upon MV into 100 is equal to 12 upon 132 into 100, which is equal to 100 upon 11, that is 9.09%. For company B, MV is equal to rupees 144, FV is equal to rupees 100, dividend rate is equal to 16%. Dividend per share is equal to FV into dividend rate is equal to 100 into 16% is equal to 100 into 16 upon 100 is equal to rupees 16. Rate of return is equal to dividend upon MV into 100 is equal to 16 upon 144 into 100 is equal to 11.1%. Therefore, investment in company B is more profitable as rate of return is more in company B than company A. Try some more problems for practice. Examples based on mutual fund. 1. If the total value of the mutual fund scheme is rupees 400 crore and 16 crore units are issued, then find the NAV of 1 unit. Given total fund value is equal to rupees 400 crore, number of units issued is equal to 16 crore. To find NAV of 1 unit. Solution: NAV of 1 unit into number of units is equal to total fund value. Therefore, NAV of 1 unit is equal to total fund value upon number of units. That is equal to 400 upon 16 is equal to rupees 25. Therefore, NAV of 1 unit is equal to rupees 25. Try some more problems for practice.